Welcome to episode 35 of the Decision Dividend with Pat Collins and me, Mark Schaefer of Greenspring Advisors. This is where logic meets life and investing. Pat, today we are going to be talking about all of these hot IPOs. Most notably, it came out recently that SpaceX is planning to go public. So what does that mean for investors, both of diversified strategies and also investors who might be trying to get access specifically to SpaceX?
It reminds me of the days when I started in this business during the internet boom. But I think this really dovetails nicely to the episode. If any of our audience was listening last week or the last episode, we talked a lot about decisions and outcomes. And this is one that's kind of really on display, in my opinion, as a great example of thinking about what is a good decision? Should I participate in this somehow? And then what's the outcome? And I think we're going to talk a lot about the decision today, which is what are all the things that should go into making a decision on whether you should participate in this? What is the probabilities? What's history tell us? What perspective do we have on that? We don't know what the outcome is going to be at this point. So I think that's going to be to be determined. But I think one of the takeaways from last week that I thought you really put well, the outcome tends to influence how we perceive our decisions. And so depending on what SpaceX does and depending on whether you participate in that or not, it's probably going to be heavily influence whether you think you made a good decision or not. We're going to give you hopefully the data in this episode to hopefully make a good decision. And hopefully you can divorce that from the outcome that you end up having.
Yeah, 2 of the 5 tools we talked about last week will be prominently displayed here. One, base rates. Right. So what is the average expectation for IPOs? And is something like SpaceX and OpenAI and Anthropic, are those really average scenarios? So we'll kind of maybe talk about that a little bit. And then 2 is that outside inside view, which is, hey, if you view it from somebody else's perspective, what do you think about this situation? But I mean, I think one of the nuances that makes this jump out is just the fact that there is so much hype around those 3 companies in particular, the valuations that have been quoted, the pricing in terms of the market cap and how big these companies could be. So I think that's maybe like one of the unique things where IPOs happen, quite honestly, a lot. Most of them are small. And so nobody really kind of sees them unless it's something that you have particular expertise in. But here, I think everybody in America is kind of reading these headlines and across the globe.
Yeah, I thought it'd be fun to kind of just look at what the expectation is for this most recent one with SpaceX. You know, they are estimating a market capitalization of 1.75 trillion. That number is really hard for many people to comprehend. But just to put it in perspective, if that turns out to be the case, that it actually goes public and that's what the valuation ends up being, that would put it at the 8th largest company in the world. So it would be a mega cap company, basically. A few things just to mention on that. First is when you look at its revenue or anticipated revenue, which is a little over 18 billion in revenue, which is a lot of money, but it puts it well north of the 500th largest company in the US. I tried to look for some comparables of what companies kind of do the same amount of sales as SpaceX is doing right now. Here's 3 examples: Illinois Tool Works, Best Buy, and TJ Maxx Ross stores. So, you know, you would never think of any of those companies as being one of the top 10 largest companies in the world. So obviously a lot of hype around SpaceX, a lot of hype around the future potential of it. It is trading at 100, or if it goes public at that price, it's trading at 100 times revenue. And that is a staggering valuation to pay. So obviously, you know, that would mean if it maintained its current revenue count and it had no expenses, it would take about 100 years to pay you back, basically in the form of dividends or earnings or whatnot. And so clearly what the market is probably saying here is we expect there to be lots of growth out of this company. That it is not going to be $18.7 billion for long, that it is going to grow substantially over the years. And that's kind of the bet that you're making.
One note, which we'll kind of get into maybe a little bit when we talk about how diversified investors might get exposure, but that $1.75 trillion market cap, That's kind of if they were to list the whole thing. What they're really talking about is a lower free float. Listing, that's going to have a lot of implications, but that's actually going to, what amount of shares can you actually purchase and can be sold on secondary markets? That's a much smaller number, where that might be, call it 5% of that. And then there's all these different types of things like insider lockups that are going to come into play that really reduce a lot of the actual volume that's available for trade. So what are the implications of that? Volatility is one of the implications of that. But yeah, SpaceX, if you look historically looking now, one note on this is, to your point, the numbers that we're looking at, those are past profitability type metrics. The research does show that past profitability is a really good predictor of future profitability. And it actually predicts future profitability pretty far out. But when you see these really, really high expectations, just know it's going to be really tough to meet those expectations.
Yeah, absolutely. I think it's probably maybe taking a little bit of a step back from SpaceX, just talking about the broader landscape. There's just been an overall trend over the last 20-ish years or so of less companies going public than probably, pre-2000, let's just say. And there are lots of reasons for that. There's pretty significant regulations if you're a public company. There's a lot of shareholder protections, SEC requirements for, and it's costly for companies to do that. There's a lot of public disclosures that you have to make. So a lot of companies have decided to stay private longer or stay private indefinitely. And I think the other thing that's come up over the last 20 years is just the rise of private equity. And so there are other pools of capital that you can tap into as a company that allow you to stay private without having to tap the public markets for capital. So that's kind of why I think, in a lot of ways, these IPOs of OpenAI, Anthropic, SpaceX are exciting. Is you don't see them every day. You don't see them every year even. It feels like maybe once a year we have one of these types of things. So I do think that creates demand. And to your point, if only a very small float is available for the public, that couldn't even, and I think there's some research to suggest that it will drive prices up even more potentially, at least in the short term, on the day that it goes public.
Yeah, for people that get the IPO price. And to your point, the last time we saw a big wave of IPOs kind of come out, there was a lot of research done after that, because that was during the internet, what we now call the dot-com bubble, right? There's a reason for it. Well, right afterwards, all this research came out to try and understand exactly what was happening. Because if you look back in the late 90s, you do see a ton more IPOs. You see a lot more IPOs going out and like the large cap space for what large cap was at that time. You don't see like, hey, a company is private and now it's the 10th largest company out there, but you definitely see these dramatic amounts just in terms of volume, both in numbers and also dollars happening. And what's interesting is some of the research that looks at, well, why was this happening? It's because stock market prices were high. There was a lot of hype. What does high stock market prices mean? It tends to mean lower future returns. So the research goes on to say, hey, essentially, this is maybe one of the best forms of market timing that there's evidence for. And it's not for the investors, it's for the companies themselves saying, hey, I guess one of two things might be driving this. One, they can't get the private capital at the dollars they need to fund these next amounts of innovation that could be happening. Two, they think it's a really good time to go public because they will get a really good price relative to their future expectations.
Yeah, it's a really great point. Maybe it makes sense for us to talk a little bit about the process of an IPO so everybody understands, because I think we're throwing around this term IPO, and obviously it means an initial public offering. But I think it's good to step back and understand who are the players, how do you participate in it, and what does that look like? And then we can kind of get into what the research talks about when it comes to IPOs. So just first talking about the IPO process itself. a company that wants to go public, there's obviously filings and things that you have to do to kind of present yourself to the public. But ultimately, you're choosing typically a bank, an investment bank, to take you public, an underwriter. And they go on what's called like a roadshow where they will go around and they will basically talk about how great your company is and try to drum up interest from investors. With a company like SpaceX, it's fairly easy to drum up interest. But there's, as you pointed out, there's lots of companies that go public every year that you never heard of. So this process of trying to find investors that would be interested in investing in this new public company is a process, and they charge hefty fees to do that. Typically, what we tend to see is that they are setting a price for investors, and that's kind of what investors get allocated at. So they might say, we think that the valuation of this company is going to be $100 a share. And typically they'll set the price a little under that to kind of incent people to invest. So they would say, maybe we're going to give you a $90 a share purchase price or allocation price. And the hope, obviously, is that that entices a lot of people to invest, and therefore then they're able to fill kind of what they need to fill. It's an interesting dynamic of what's happening, because when you think about from the company's perspective and from an investor's perspective, there's very dueling incentives here. So from a company's perspective, you want to get the highest price possible, because obviously all of that money is being funded, is helping you fund your operations. This is not secondary market trading at this point. This is, we're trying to raise capital for our business. We're selling shares to the public. So we want to raise as much as we can. So they want to set the price as high as possible. Investors want to buy it at the lowest price possible. What I love about public markets is that there are willing buyers and sellers that are coming together every single day and setting the price. The IPO process is not like that. There is an underwriter setting the price. There is no market forces that are working to set this price. So I do think that's a little bit of a challenge with IPO investing, is how do I know if I invest in SpaceX and I get allocated shares? How do I know that's the right price for SpaceX? I don't really. I'm hoping that the underwriters have priced it well. I'm really hoping that they've priced it under market as an investor. Obviously, SpaceX would rather have the opposite. They want it priced at the highest price possible so they can sell less shares and get more money, basically. So that's kind of the first step, is this process of going out on a roadshow, trying to induce people to invest through this kind of market. It's basically, I've sat through many of these over my years, marketing kind of exercise of learning all about the great things about this company and why they're going to outperform in the future.
The market pricing mechanism is what you describe. You get a bunch of people in the room, and essentially they're thinking about what's their price target? What do they think it's worth? Now, what you don't really know is, all right, once this massive thing happens, is what I think the price is that really going to be reflected? How's that going to pan out? So there's a lot of uncertainty, which is why there is this whole process. There was a really good Wall Street Journal article that kind of talks about what's happening with SpaceX, talks about how all the investors are getting on planes and they're going to visit the rocket making factories. And then it's not just a rocket company, it's an AI company too, Pat. So now they're going over to Memphis to look at the data center to help them get an idea of, hey, what's the price going to be? And then how much do each of these people want to get allocated to? And what you see from the research, there does tend to be a day one pop. People ask a lot of questions around, well, why would a company want a day one pop? I think the most logical thing is they're going public because they think they're getting such a good deal. They're okay leaving some additional money on the table in exchange for the positive press that comes out of having their price go up on the first day as opposed to go down on the first day. That's not a good indicator of the future of your company. And then that article also talks about how IPOs have changed in the sense of the bigger they get and the more they're spreading out these allocations, they essentially have to call each investor and be like, hey, you still are going to invest $1 billion, right? Okay, I'm going to get you $1 billion. And they got to go around to do that with a bunch of different investors. And that's pushing back the time that these shares actually go publicly traded, which means investors like you or me can buy it, which might also increase the volatility, because instead of saying going live at noon, now it might be 2 or 3 p.m. the day of. There's a lot of different investors. So do the systems work? There's all this uncertainty, which might kind of compress more trading in less time, more volatility. Pat, maybe just also talk about how hard it is to get that IPO price allocation.
Yeah, it's a big determinant you've already mentioned is the float. So what percentage of the firm's its shares are going to be available for investing on that first day will represent it. So if you have a company, I think what I'm hearing about SpaceX is that it's around 4 to 5% is what they're talking about which is the float, which means 4 to 5% of the company's outstanding shares, total shares, are going to be available for investment that first day. That's a small amount. That's just to be clear, that is a very, very small number. So now what they have to do is, these underwriters are now allocating these shares to companies, like Goldman Sachs and Merrill Lynch and Morgan Stanley and all these big companies, Charles Schwab, Fidelity. And then they are deciding which of our customers are we going to allocate shares to. And there's rules on this, but I can tell you that, this is part of the process, having been through this. One, a lot of these companies will either impose directly or indirectly some sort of lockup period where they say, yeah, you can get these shares. We're going to allocate these shares for you, but you can't sell them. You can't sell them for 30 days, let's just say. And so the reason for that is they're trying to avoid people just literally day trading these shares on the first day. All the research says is most of the returns are made in IPOs on the first day. So it's one of those things that's a little bit of a challenge if you're investing in these IPOs. So they're typically giving it to their largest customers. The customers that generate the most fees will get allocations of these IPOs. The question is it good? I mean, obviously, there's the IPO allocation price, which is what you pay for it before it starts trading publicly. Then the next step would be, well, let's say I don't get an allocation of these shares. I'm not a gigantic investor at one of these companies. They don't give me an allocation. How else can I participate? Well, as soon as it starts trading that day, I can just buy it. Now, the question is at what price am I buying it at? How much different is that than the allocation price? And it tends to be pretty significant. I mean, I think the research showed that, it can be somewhere in the 15 to 20% range of a first day pop. So meaning the allocation price, how that differs from what you can buy it at on the open market, basically. And in cases where it's a large IPO with a very small float, it can go even higher than that. It's kind of an interesting, I think one of the research pieces that we read showed that large IPOs with a small float might have a 30% plus return on that first day. And it gets me thinking of how much money I feel like these companies are leaving on the table with that kind of thing, where that's money that could have gone into the company's pockets to invest in R&D and grow their business and create jobs. But in fact, that 30% stayed in the investors' pockets, basically, which again, if you're an investor, great. If you're a company, not so great. But yeah, this process is an interesting process. It kind of happens behind the scenes. Having been at a large brokerage firm, they'll have an IPO that they'll take it down to the office level and they say, for this office, we're going to allocate 100,000 shares. And then you kind of have to grovel as an advisor to say, I have a client that really wants this or whatnot. And so it's this long drawn out process. But at the end of the day, what I think happens most of the time is the largest clients tend to get the allocations. I still think it remains to be seen after the lockup period whether or not it's actually good. It feels fun in the moment and feels like this, exciting process that you're getting first access to a company. But I'm not sure that the data plays out that it's a great long-term investment.
You mentioned lockups, so maybe I'll just walk through what that is for the investors already owning shares of these IPOs. When they go public, they cannot sell all of their allotment. So they might have 6-month allotments. They might have shorter allotments. So these are companies like people like the CEO or long-term shareholders, right? So there's going to be these lockups where, hey, you can't even do anything if you want to. So that's one level of liquidity constraint. Then there's a second level of liquidity constraint, which is what the underwriter, this is the investment banker that's trying to control this process, is doing. And when they're calling companies saying, hey, would you like to invest $1 billion? They want to sell that $1 billion to somebody that's not going to turn around and dump it on the market. Because what do they want? They want that IPO pop. And if you dump $1 billion, that might not mean you get the same big day pop. So when you were talking about, hey, there's typically this one day pop, low float might mean 30%. If it's higher float, that might mean less, but it's still meaningful. It's still 10 to 20%. It's not like they left 10% of $2 trillion on the table. They left 10% of 10% on the table, type of math. But they really, like, there is, it's interesting. There's a lot of focus around making sure they set the conditions to create these one day pops. So if you look at the research and you exclude those one day pops, the performance of IPOs in aggregate is not good. And that's not saying that there's not IPOs that have done well. It's when you take all the IPOs and you look at the longest data, and even when you kind of exclude the internet pop, even when you look at kind of, well, let me take the new millennium, when you cut the data different ways, you still see underperformance relative to a kind of market cap weighted portfolio, whether that's total market or just small caps. You still see very significant performance differences of negative a few percent to, in some cases, depending on how you cut the characteristics, terrible performance, like negative 25%, if you're truly trying to say, let me find the closest comparable group of peers to this company based upon some metrics.
Yeah, there's a study by a couple people, Ritter and Welsh, that looked at this. They probably have it looks like the longest running study I found. So they just recently updated 1980 to 2024. So we're looking at 44 years of data of looking at all IPOs that have come out in the market. And what they found was, on average, first day returns were 18.9%. So that's that pop that we were talking about. So that's the average. Some are better than that, some are worse, but that's pretty good. Unfortunately, very few people are realizing that because they have these lockups. They can't sell it after that first day. So then if you look at it and say, well, what happens if you hold on to this IPO? The average 3-year market adjusted return were negative 20.5% over a 3-year stretch. That means that it's trailed the market by 20%, basically, cumulatively. And then if you say, well, that's not fair, these are tiny little companies, why would you compare it to like the Googles and the NVIDIAs of the world? So if you then just say, well, I'm going to adjust it and only look at like a small cap index kind of thing, it still underperforms by 8.9% cumulatively over those 3 years. So to your point, not good. If we go back to last episode that we had around thinking around making good decisions, what this is not saying is that all IPOs are bad. We're just saying in aggregate they have historically done worse than the market, and so as an investor, we should really take that into account. It doesn't mean we can't invest in the SpaceX IPO and make a lot of money. We might, we don't know, but we know that's probably a bad decision with a good outcome. If we were just a pure raw look at the data here. So I think that's a really important element for people to understand.
Yeah. And Pat, were you quoting the offer price numbers or the after the first day close numbers?
It looks like it's offer price from what I can tell here.
So Ritter is like the famous academic that just studies IPOs. So this is what he does. And he's been doing it for like 30 years. And you see this offer price number and you're like, hey, it might be good. It seems like a good case. You see a lot of negative numbers relative to the market or relative to what he calls style adjusted. That means controlling for these factors of expected returns that we've talked about before. And then if you look at from the first close, almost everything goes negative. Now, it's not to say, to your point, these are averages, right? So how can we dig a little bit deeper? And this is where those factors of expected return come into play. So what are some characteristics of IPOs that might be more favorable to give the benefit of the doubt. And it's the same factors of publicly traded companies, right? If you're a large company, you have a lower expected return. One of the big ones that's really easy to tell is about profitability. So is a company profitable or is it not profitable? That really helps skew the data. It still doesn't make a case for buying profitable IPOs at the close. Still doesn't really make a great case for that. But what it does tell you is, hey, if a company's profitable, which according to the offering documents, SpaceX is not expected to be profitable, that would have made a stronger case. So there's a few characteristics. You talked about free float, meaning if a company's willing to put more of its shares on the open market, there's a higher likelihood you might get better returns in the long run, less returns in the immediate term. But yeah, these factors that we think predict long-term expected returns, we see them in IPOs as well.
Yeah, I think if you have an interest in this, we've talked about this in several episodes. We had one a few episodes ago around factor returns is kind of what we call it, but it's exactly right. There are research that showed that there are factors that really influence stock returns over time, and IPOs tend to have all of the worst characteristics when it comes to factors. So maybe not all, but a lot of them, which is low profitability. That not all, but a lot of them have very low or no profitability for that matter. They also tend to invest a lot in their business, so they can't distribute cash flow to investors. They can't, they have a capital intensive business. SpaceX, OpenAI, Anthropic, great examples of that. When you look at their business, of how much money they're investing in data centers and all sorts of infrastructure, it makes it harder, obviously, to, when you look at these factors, investment being one of them, does a company have to use a lot of their capital to reinvest in the business? It's not a great trade. So all reasons why it's you have to be careful investing in these IPOs. I do think maybe even taking it a step further for clients of Greenspring, but also just in general, I think a lot of people have, at least probably a lot of our audience, have decided to invest in the markets through kind of broad market index funds or some other way to kind of own the market, basically, rather than try to pick stocks. Those stock pickers that are listening to our episodes are probably very, very disappointed. So I think the people that are listening are the ones that maybe agree with us. So I thought it was interesting in doing the research of, well, how do these indexes think about this? A SpaceX comes on the market and is immediately the 8th largest company in the world. Do they get included in the index immediately, or how do these companies? So, we looked at it. Do you have any thoughts on that? Because I think there's some really interesting, I found it interesting on how each of these indexes look at these things.
Yeah. So if we summarize, hopefully we convinced people that we do not believe buying in at IPOs is a smart decision. That leads you to this natural question, which is, hey, if they're a part of the market, I should own it, right? And the answer is yes. And what we're talking about is how to be thoughtful about the timing of how you own it. And there's 3 different ways you can think about capturing some of the economic benefits of these companies without participating in the IPO. One is, if your investment, when do they actually start buying, which is what you're talking about, index inclusions, or when does it become eligible? That's one consideration. So let's talk about that. Second consideration is going to be, do you already own stuff that owns shares of these private companies? And, not to bear the lead, yes, you actually already own shares of these companies if you're a diversified investor. And then the third thing, which you also probably have exposure to if you're a diversified investor, is, do you own other companies that are economically benefiting from the innovation that's happening? And yes, you already own. So I think there's 3 different ways that you're still going to be getting benefits that you don't have to take this low expected return, high concentration, buy at the IPO price to get. So what you're talking about, Pat, if we just want to focus on it, this is the index inclusion. And there's actually been a lot of conversation about this because these are such a big, to your point, it's very rare to have so many companies go public at such a high market cap. We're talking like the market cap of other countries, by the way, that all these index companies, they're asking this question themselves, which is, well, when's the right time to add this? And there's a few considerations that they'll be thinking about.
Yeah, I think we looked at S&P, which is probably one of the most famous index providers, S&P 500. They have a number of indexes. But their rule is basically it needs to have 12 months of trading before it gets included in an index. So theoretically, SpaceX is not going to be included for the next year, or Anthropic or OpenAI in the S&P 500, even though it could be in the top 10 of largest companies. The S&P 500 represents the 500 largest companies. So that's just a rule. It kind of goes back to our, index investing is not truly passive. There is decisions that these index providers are making on whether to include or not include a stock. And that's kind of an active decision. So to say that we're purely passive when we own the S&P 500 is not really accurate. But expect if you're an S&P 500 shareholder or owner of a fund that invests in the S&P, you're probably not going to have exposure directly in these stocks for some period of time for the first year or so.
Yeah, there's you have to be traded for a while. Then there's for the S&P 500. There's also a committee, right? They have to do it. And then the third big hurdle point for them is you have to be profitable for 4 quarters to be eligible. The most recent example we have of this, and this is why we just think indexing's great. It's better than most other alternatives, but be cautious. The most recent example we have of a very large company being added to the S&P 500 is Tesla. And what happened when they added Tesla is they hit that 4 quarters of profitability. The secretive committee got together and said, we can't ignore this any longer. We're going to add Tesla. They've met our criteria. And you know what happened? The stock ran up in price a ton. But it's not, if you're an S&P 500 index owner, you didn't get that because it's not added yet. So what was happening? Front running was happening. A lot of these, everybody knows, hey, on this date, at this time, there's going to be a lot of buying of Tesla. The stock went up, I think like 30 or 40%, if I remember exactly what happened before it was added. And then the moment it was added, subsequently dropped 5%.
It's the real downside of index investing is that, we've talked about this in prior episodes. If you're interested in really digging into how, this is definitely in the weeds and kind of nerdy investment talk, but how index gets, gets created, but then also gets traded. And there's a lot of smart people in the market that understand that Tesla is going to be included in the S&P. That means that billions and billions of dollars are all going to have to pour into Tesla to include it. They have to own it inside of their fund, and they get ahead of it. And they basically bid up the price prior to that, knowing that that people are going to buy at that price, because an index investor doesn't care about price. They care about matching the index. That's that's the important part. So S&P obviously has specific rules. All the index providers have their own. We saw another one, FTSE, which is another big global fund, allows IPOs to start trading after 5 trading days. They can put that into their index. MSCI has a different methodology. It seems a little bit more kind of discretionarily by committee. So it is likely these bigger companies, you will eventually own them directly. It's a question of when and how and at what price are you getting them at, I think, is the other part. So we tend to favor companies like Dimensional Funds or Avantis, which has got a little bit more flexible trading philosophy and either inclusion, exclusion, or when to start adding it, and trying to keep in mind of all of these kind of downsides of just automatically including in an index and getting this front running that you talked about. And so I think it's an important aspect of thinking about what type of index am I investing in and how does it participate in IPOs, and is that adding or detracting from the portfolio?
Yeah, it is incredibly challenging. And I think it's really hard for these index providers. Something like $2 trillion tracks the crisp US market. That's Vanguard's big US market tracking solution. So when they're allocating, they're talking tens of billions of dollars on any given purchase. Vanguard owns something like 10% of every single stock out there in the US. So when they're making these decisions, they know there's going to be implications, and they're trying to build into the rules ways to protect themselves. So they're thinking about these fast track inclusions, which is, hey, can we make exceptions when they're exceptional IPOs? Okay, that's a decent framework. The challenge is it's really hard, and you're kind of weighing these two things, which is the mandate you're given from investors is to represent the market. So you want to own everything as quickly as possible, but you also are looking at the same research everybody else is looking at, and you're saying, I want to own positive expected return companies. So they're trying to balance this and find a middle ground. And there was a lot of conversation about exceptions to some of their rules and whether or not that would help them win the listing business. And I think it just goes to show that, again, these are minor different. They are big, but it's going to be smaller pieces of total performance. But it goes to show, because we've solved so many aspects of investing, we're now at this nitpicking phase, and there's value to be had. Somebody did some research around CRISP, how they think about fast tracking, and all these other considerations. It's multiples of the expense ratio. So these are big outcomes relative to the expense ratio, but only because we've driven expense ratios really, really low. So yeah, it's really, really important. The narrower your index you're going to be looking at, I would expect a bigger risk or outcome. If you're thinking a total market US strategy that owns 3,000 stocks, okay, it's going to matter. It's going to be less. The S&P 500 is going to be more impacted. Something like NASDAQ, which is 100 stocks, I think would be more impacted by these decisions compared to other indexes that might be more diversified.
Yeah, absolutely. I think we've probably exhausted the IPO kind of landscape here, but I think there's some takeaways that I thought we could leave our audience with. Maybe some of the most important things that I see. One is just going back to, trying to make the best decision you can with the information that you have. And so I think the data says if you were getting an allocation of these shares, if you're able to get an allocation, there's some evidence to say that it may not be a bad thing. This is a large IPO, all three of them, with fairly small floats. It may not be the worst thing in the world. If you were trying to buy at the open or buy in the secondary market after they go public, then the data is really is a much more clear in my mind that it is on average not a great investment decision compared to investing in the market in general. So hopefully people can take this data, make a good decision with what to do about these IPOs. Our suggestion would be own the market. You already have exposure, to your point. OpenAI has a massive investment from Microsoft inside of it. Google owns SpaceX. You are getting exposure to these companies just through your regular public investments. And eventually your market index fund or your market, your fund that tracks the market is going to own these directly as well. So you will get exposure to them, but trying to do it individually, we feel like is probably not the best bet for most investors.
Yeah. And, the other thing is, those other economic benefits, Pat, I think are really, really huge. I don't think it makes sense to buy the IPO. I guess I'm more cynical. If you could get access at the IPO price, I would wonder what other fees you're paying and why somebody would give you that access, because it's such a good screaming deal. 2, publicly traded companies have they call them CVCs, corporate venture capital arms, that are investing in private companies that they think could be beneficial to their business. And then 3, look at the whole stock market across the globe and think about all the volatility we've had this year when it comes to headlines. Benefits seem to be accruing across the economy, at least in terms of stock prices. So that's another comforting sign. Hey, which I think is actually ironic when I was thinking about this episode, which is diversified investors probably stand a much better chance of getting exposure to these few IPOs and the economic benefits of them than somebody sitting in cash waiting to to find a way to pay really high fees or jump through a lot of hoops to get this exposure.
Yeah. Great comments. I love that comment because you're absolutely right. Because I saw it firsthand that people that are getting access to these things, you probably through the IPO allocation, I would take a further step back and say, why am I getting an allocation to this? It probably means I am a great customer to this bank or this brokerage firm. That means I'm probably paying very high fees. So, if you are getting lots of allocation, just be careful. Take a look at what's going on with the rest of your portfolio.
Yeah. And one last comment, because I can't help myself, but I'm always reminded of Mark Cuban when he sold his business to Yahoo. And when we're thinking about talking with investors in similar situations, here's the stories I'm hearing from advisors. Employees of these companies, they're thinking about what Mark Cuban was thinking about, which is, hey, a lot of my net worth is tied up in this one big thing. How can I protect myself? And the reason why Mark Cuban has a lot of money still and got to own a sports team is because he did essentially the opposite of the IPO investors. He was going the other way and trying to figure out ways to get protection. So that's another, I think, decision-making framework going back to our last episode, which is, okay, put yourself in the shoes of one of these employees. Why would they want to sell if it's such a good deal to own these? Because they know there's a lot of risk and concentration. You should factor that in. All right, Pat, thanks for this. This was fun.
Yep, absolutely.